Hello, I'm Brad Maclean, co-founder of Regulation Asia, and I welcome everyone to today's discussion. Now, it's been more than just a year since the net zero promises of COP27. Now, tangible progress has been delivered, but the world is dramatically changed. Energy supply, reliability, and living affordability have become top priorities for many countries and policymakers, presenting fundamental challenges to the global climate agenda. Other issues, such as double counting of greenhouse emissions reductions, inadequate transparency, and greenwashing risks, also need to be addressed for green financial markets to reach their full potential. From my perspective, at least, it's going to take a combination of vision and pragmatism for companies, governments, and society to reach our net zero goals. Now, to support this transition to a green economy, financial markets and their products, including ESG derivatives and carbon credits, are likely to become vital to this transition. And this is what brings us here today. I'm joined by Scott O'Malia, Chief Executive Officer at ISDA, to explore what is needed from financial markets to make a real difference and the efforts and initiatives underway at ISDA to help us achieve our net zero goals. Welcome, Scott.
Thanks for having me.
Not a problem. I mean, as a starting point, so I'd like to kind of really drill down on some of the geopolitical events, such as shortages in gas supplies and higher energy prices. These are just some of the factors shaping recent policy discussions around ESG. From your perspective, how are regulators responding to the growth in sustainable finance and the increased focus on environmental, social, and governance issues?
Well, I think, as you noted in your opening, these are important issues right now. Regulators have put this ESG issues, particularly the climate issues, right at the top of the agenda. We hear about these kind of every fall about the aggressive policies that the policymakers around the world have agreed to it coming out of the COP meetings. And this is a top priority. Making sure that we have a sustainable roadmap to achieve net zero by 2050 is what the regulatory objectives and the policymakers have set out as their goals. Similarly, companies have also agreed to set net zero targets by similar timetables as well. So we have a real convergence of public sector and private sector really kind of addressing this and making these commitments. Now, as you noted, the gas supply issues, the energy transition to a more sustainable economy and sustainable production in energy is kind of definitely impacted by energy security issues. So you can't really have energy transition without proper energy security, and that's come kind of front and center with the Russia invasion of Ukraine and the disruption to energy supplies out of Russia. Europe has had to find alternative solutions this past summer. And through this winter, we've been all kind of waiting to make sure that we've had adequate supplies, but this has had a big impact on price. My energy bills here in London have gone up substantially, as have all energy bills across kind of Europe, as they've scrambled to get those energy supplies to make sure that there was enough gas and proper supplies available through this winter. Now, it's been a relatively mild winter, so it's been stable, and there have been adequate supplies and storage to meet demand. So that's the good news. There hasn't been major disruptions, no blackouts, no curtailing of supply into homes and businesses. So it's been relatively stable. But these were, if you wind back the clock 9 months ago, we didn't have that certainty. We didn't have that clarity. And Europe was scrambling to put enough gas in storage to kind of make sure we get through the winter. This is going to still be an issue for the next couple of years. So we're thinking about, this energy transition very, very carefully because of the energy supply question. But I don't think that changes the objectives of policymakers. They're still very committed to an energy transition here in Europe. And I think this jurisdiction certainly has the most advanced strategy. They've had a carbon trading market, a compliance market for over a decade. Carbon's trading at about $100 or 100 euros per ton, kind of a peak in the operations of this market. So it's definitely signaling the price of carbon a little bit here. Now, other jurisdictions are taking this in a much different approach. In the U.S., the big energy policy solution or the climate solution has been the IRA bill or the Inflation Reduction Act. Whatever its name is, there's a huge amount of investment provided through tax credits and subsidies to support the energy transition in the U.S. a ton, actually. I mean, a massive amount of funding that is going towards this energy transition, towards renewables and alternative energy sources, which is having I think will have a big impact on investment in the United States. Now, that approach is completely different from the strategy here in Europe, and there's a bit of this competitiveness that they're looking at each other and saying, your policies are protective and supportive of U.S. business, not fair to European businesses. So there's a little bit of back and forth that's going on right now between policymakers. But Asia's not going to be left out of this either, right? Japan, we have a carbon market. China's talking about its own carbon market as well. So, the conversation is joined up. It is really joined up, though. It's not joined up together. It's joined up separately in some sense. Everybody's pursuing their own strategy on a national basis, but they are proceeding along some consistent courses. So our job here at ISDA will be a bit to help advise our banks and buy-side members to how to manage this, how to think about developing products and solutions that drive investment into those sustainable economies, how you achieve net zero, and how you get credit in each of the various different jurisdictions. We would love one big harmonized solution, but that's not going to be the case. And so we have to kind of work across borders and knit together different consistent solutions.
So given the focus on transition, what types of ESG-related derivatives products are you seeing emerging in the market?
Well, keep in mind, derivative products are hedging products. And we think about that as you manage your underlying risk. So if you do invest in green bonds, we want to make sure that you've got, you still need to have those derivative products to manage your risk. As you think about developing investments, long-term investments on the scale of it, we need trillions of dollars to invest in green economies, in more sustainable solutions. And that has to happen over many, many years. I mean, we're really at about $1 trillion in 2022 in sustainable investments. That number needs to go 7 times larger to get to the goals of 2050. So we need to drive a massive amount of investment on a global basis into these products. And I think that's where the hedging tools can give you some important risk management. So managing your interest rate risk. This is an inflationary time. We see the impacts of higher interest rates all over the place. You've got cross-border issues, so you've got FX you have to worry about. You've got counterparty credit issues you have to worry about, liquidity issues. So making sure you can put the trillions of dollars necessary. You really need to have good risk management. I think that's where derivatives can be really particularly helpful. Now, pardon the pun, there's really no such thing as a green hedge, as it were, but it does support. I mean, these are just fundamental good practices around risk management. So if you have green investments, or you're investing in, a facility, a wind farm or solar facility or hydrogen facility or carbon sequestration facility, these are going to be long-term investments that you have to manage that risk. So that's where we can really come in, and those are just typical derivatives. We're also looking at kind of greener products, and that would be around the voluntary carbon markets. We're very interested in that market and supporting that through the development of best practices, making sure that the legal foundation for voluntary carbon markets is well established. You know what you're trading. You know what the bankruptcy treatment of that product would be in case of a bankruptcy. And we're also facilitating the trading of that product by supporting the development and updating definitions. So everyone has a common set of definitions the world around. Another interesting product that's being developed on a very bilateral basis is sustainability-linked derivatives. These are tied to long-term financing needs, and they basically create a cheaper funding source if you hit certain KPIs or key performance indicators. So if you have a long-term funding solution, a bank could give you discounted funding and discounted interest rate if you hit certain key performance indicators on this journey to making this investment. Now, that's a terrific tool and could make that investment more affordable. But what we're trying to do there is establish a common framework that we describe life cycle events in a common way. We establish good best practices so everybody understands what excellence looks like, and making sure we don't have any greenwashing in that regard, and that regulators really understand this product throughout, and so they can they can kind of give credit and encourage that kind of behavior over the long term. The other bit is managing the capital risk. I think, as we think about the capital rules, we want to make sure that those are risk appropriate and not unduly punitive in any way for green products or sustainable products.
Okay. There's a lot to unpack there, and hopefully we'll have a chance to delve into a lot of different aspects there. But I guess as a starting point, you have obviously raised a number of different products. So what is driving appetite for these types of products, and what role do you see that these types of products play in advancing the green transition?
Well, I think it really is this net zero objective. Policymakers have kind of set it out, by 2050, and so many corporations have set their own net zero calculations and objectives. So they're making these investments for the long term. That's the most fascinating, interesting bit about all of this. It really takes long-term, significant funding to really make this to make this enduring and lasting for the long term. Because these investments, we're talking about changing our energy infrastructure completely. To transition away from fossil fuels to more renewable sources. That takes time and it takes a huge amount of money. So people are really thinking about the long-term funding needs. As corporations turn over their capital stock and they think about their production value, how are they going to get on that path to net zero? So this is where corporations are taking that long view and really thinking about those investment needs for the future and how they transition to that. So, where they allocate capital to production and developing new solutions is critically important. So that's what's driving this, both from a policymaker and a corporate level. Also, investors. Investors are demanding greener products. They want to know that the corporations that they're investing in have a greener strategy or sustainable strategy, or they put their funds in their investments in funds, whether kind of mutual funds or other sources, pension funds as well, that also achieve some more sustainable investment policies. So, and sovereign wealth funds as well are also driving this. So there's a massive amount of capital really being funneled to these more sustainable solutions, and as a result, I think we're on a path that I've never seen before. I've been in energy policy for a very long time. And, you've seen these kind of enthusiasm for greener products and more sustainable investment. But then it kind of fades away. 2006, 2007, there's a lot of enthusiasm. We created the loan guarantee program in the Department of Energy. There was a lot of enthusiasm. And then we got hit by a financial crisis, which, took the wind out of the sails there. So, you see these blips over time that kind of come and go. This one seems more enduring. And I think corporations have really made some long-term commitments to this path.
Okay, so then what is ISDA doing to help advance the development of ESG derivative markets?
Yeah, so it's really pretty fundamental to what ISDA does. It is establishing that strong legal foundation around these types of products, making sure that voluntary carbon markets are well understood from a legal standpoint, and this varies by jurisdiction. In the US, they're commodities, so they'd be under the CFTC's commodity definitions and therefore behave as commodities. Making sure here in the UK, we have clarity as to whether they're property or an intangible asset. That matters kind of in the event that there's a default or something goes wrong. Inevitably, things will go wrong, right? That's just the way things are. So we want to make sure that legal clarity around these types of assets is well understood so you can manage that risk when you make your investments. You understand what your upside is, you understand what your downside is. That's just good risk management. So we want to clarify that. The other bit is working to make sure that we have updated definitions. And we've had for some time, we've really had definitions around commodities and voluntary carbon markets, but we've wanted to update those as things change. We're working with IETA, the International Emissions Trading Association, to align the primary markets, the cash markets, with the futures or secondary markets. And that's just good, smart risk management. We don't have any differences in definitions. We're trading the same product. That really makes a difference. It makes just coordination and efficiency in that transaction. So that's important. We are unpacking this issue of sustainability-linked derivatives and making sure that we have clarity as to what the best practices around those derivative products should look like. We're also working here in Europe to make sure that we have consistent legal treatment and regulatory treatment around the taxonomy that the European policymakers are pursuing. So making sure hedge derivatives fit into their definition of what is green, because we want to make sure that, just like in accounting rules, that the cash market and the hedging tools go hand in glove, and making sure that there's no difference and you get credit for both of those. It's part of the calculation as to what a green initiative is or a green investment is. And so we just want to make sure that the clarity around those regulations is well founded. And the other bit is making sure the capital treatment is shored up. So we have risk appropriate capital treatment, not punitive capital treatment of these assets.
How concerned are you about greenwashing? And I guess more importantly, what could standard setters, I guess, at a national level to help prevent this type of activity?
Greenwashing is another term for fraud. It's a problem. It's not a problem. It's a problem we need to look out for. I don't think that most of the market has greenwashing in it. So we just have to, there's no acceptable level of fraud in any investment markets. And we want to make sure that we don't have that. I think there's some concern that people have raised around the transparency, the auditability, the clarity around some of these voluntary carbon products. And there's some concerns about that there might be double counting. There's a lack of transparency, not a consistent register of products, not a lot of understanding or consistency across products. So there is some concern that maybe not all of them are up to the highest standard. Well, we have to do something about that. If we want this market to be a viable market, to be a successful market, to help us price carbon, to send the right signals around these long-term investments, we really have to make sure that there is absolutely no greenwashing or fraud going on in this product. So there's a number of initiatives. Regulators are looking at this very closely. The CFTC has been kind of outspoken recently about saying they're going to address this issue. But the Integrity Council for Scaling Voluntary Carbon Markets has been focused on this for over a year. And this is a great initiative, and they're working through. They've got, kind of both parties from the green and corporate side. We've got government involved. So we're really focused on making sure that we set very high standards so we have a robust market in voluntary carbon markets. They're probably going to be, at the end of the day, once the voluntary carbon market standards are published, and I understand they're going to be coming out in the next couple of weeks or months as we record this in March. But so we should be looking for these new high standards. But then we have to take those on. I'd like to see a higher standard than kind of where we are today, and I'd like to see some of these credits kind of go away, because today it's trading at a price that's too low. So there's a massive demand for these, as we established, right? Net zero strategies. Corporations are thinking about how they're going to reduce their emissions, and then those emissions they can't reduce, they have to kind of offset those through voluntary carbon markets. Now, voluntary carbon markets are great investment tools. You can take, you can sell a carbon credit, and that'll support some new and innovative technology. I think they can be very useful in bringing new technologies to the market, because they do have this green feature in this way to offset and remove carbon, which is fantastic. But we need to make sure that those are high standards, and we have consistency, we have transparency, and we can audit that, because no corporation will be purchasing a credit that they find out later is fraudulent or part of double counting or has some low standard. They want to buy high quality credits, and they should have a way and a mechanism to look into that and be confident that when they go to their investors and they go to their boards and they go to their regulators, they say, these are going to hold up. These are offsetting, they're reliable, they're going to reduce carbon, and they're part of our strategy. They shouldn't be, we don't want them, these are not M&Ms. You don't want to grab them by the handful and just pop them in your mouth, right? You need to these are offsets of carbon you can't otherwise reduce. Now it's a journey. It's 2050 is the goal. We have to get to that, and it's not going to be immediate, right? We're not going to just eliminate emissions entirely tomorrow. we want to do it as quickly as possible, but we have to think about the transition. And some of these carbon credits are going to be very useful in mitigating the emissions you can't eliminate today. So they're part of an overall strategy, and therefore they must be robust. We need the demand for these is up and to the right. I think there's a significant demand for these based on the net zero, but the price is too low, right? It's too easy to use offsets first, and I think we need to get rid of some credits of low quality value, and then that'll bring the price up, which will signal important investment in alternative and innovative technologies that can really be transformative, I think.
So it's interesting that you've mentioned standardization will be a journey. I mean, you've recently published the 2022 ISDA verified carbon credit transactions definitions. Can you talk us through ISDA's work to standardize the documentation available for carbon credit trading?
Yeah, we started back in 2021 to lay out what we were trying to achieve. We communicate that to the market. We explain what we're trying to deal with. We've published a couple of white papers as to define the issues a little bit better so people understand about the legal questions that we're trying to resolve and to make sure that we have good standard documentation. And then we convene the industry, right? The entire industry to come together to work through these things to make sure that we've got good definitions that are stable, enduring, and well understood across the various jurisdictions. There are different trading behaviors in Europe versus the United States, sometimes around energy trading or some of the existing emissions markets. So we have definitions to support the compliance markets in Europe, and we have definitions to support the voluntary markets in the rest of the world. And so it's just making sure that they're linked up, they're well understood. They cover spot, forward, and options contracts. They can be verified, and everybody has a high level of confidence in these, so they're going to use these effectively. That's the beauty. Two things that ISDA documentation do. One, facilitate the trade, right? Standard definitions, standard documentation, well understood terms and conditions. The other one is to manage when things go wrong. And we also have some clarity around that. Understanding what your downside risk is also important. We all want to be, feel good about the investments we're making in sustainable technologies and solutions, but we also can't forget there's a risk management component to all of this. And so it's two halves of the same nut that we have to make sure that we pull together so it's an effective tool for good risk management.
You mentioned standardization, legal certainty. I mean, one of the other key challenges in the adoption is the need for more liquidity in carbon markets. I mean, what would you say is needed to improve liquidity in the carbon markets?
Yeah, well, the word is trust. Making sure that you can trust the investments you're making sure that the carbon products that you're buying can be verified over the long term, that you can confidently make these investments, that there's no fraud, there's no double counting, they're robust and transparent. You can come back to those, and they should be long-term investments. Whether they're nature-based or technology-based, you want to be able to go back and say, yep, still on course, still delivering the carbon reduction that we expected and what we purchased over the long term. And making sure we have all of those is critically important to the future success of the voluntary carbon market. So that's where our work around legal terms and conditions and making sure we have good risk management around the bankruptcy. Because if something does fail, if something goes wrong, what are your remedies? What are your rights? How will you and your counterparty treat this in the event of a default? But also, importantly, to drive investment in these things is the first word is trust, without a doubt. And we need to make sure that the standards coming out of this Integrity Council raise the bar and have complete transparency through the life cycle of these credits.
One of the other areas of advocacy for ISDA is around the capital treatment of carbon credits under the Basel framework. I mean, can you walk us through what is the issue and I guess the impacts?
Yeah, as it stands, the Basel III market risk framework assigns what we think is a disproportionately high risk weight to carbon credits. And this is based on past trading behavior. So this isn't just Scott O'Malia's opinion or Mark Geerbrandt's opinion, who's our head of capital and risk. It's really based on market behavior and trading and the risk that these products have based on a historical review. Specifically, the fundamental review of the trading book would include a standardized approach to capital calculation that assigns a 60% risk weight to carbon trading. Now, this would be the highest of all commodities. It would be twice as high as crude oil, and that doesn't make a whole lot of sense to us based on its trading behavior. Our analysis would show that volatility during the periods of stress that we're looking at suggests a risk weight should actually be around 37, not 60. Other issues relate to the calibration of the correlation between the spot and the forward positions, and what it has on the impact. This would have a big impact on the carry position. So we've set, the Basel Committee has set a low correlation, which we don't think is in line with the empirical observation. So we've been advocating. Europe has gone first in its Basel implementation. We alerted the authorities to this disproportionate risk weight, and they've successfully changed it. The next jurisdiction we have to focus on is here in the UK. Their Basel 3.1 initiative also put that risk weight at 60%. We've communicated that to policymakers, saying, the data shows it should be 37. And then, we're waiting on the US market to see where they come out as well. And, as usual, we'll be there to provide the data and the information to make sure that the risk weights are appropriate. We're not interested in having policymakers putting their finger on the scale and tipping risk weights in the other direction that overlook the risk of any product, and nor do we want a punitive treatment either. So risk should be what it is. Let's call for what it is and make sure we set the rules appropriately, and then we can work through the other solutions.
I understand some of ISDA's work focuses on scenario analysis to assess the impact of climate risk on banks' trading books.
Yeah.
Can you explain how this work came about and the progress so far?
This is a fascinating challenge. When you think about the complexity of identifying which of the various climate solutions, right? There's people always debating about the severity of different weather patterns and climate impacts over the long term and how that will play out. And that, we won't know until it happens, obviously, whether we're accurate or not. So there's a lot of complexity on the establishment of the right of climate scenarios. And then we're trying to extrapolate that to understand what impact that would have on the trading book and assets and impact the bank's trading books. And that's a complex modeling exercise that is both fascinating and extremely challenging. Our teams are really excited to kind of dig into this and understand the variability, the scenario, and the various impacts that could be transmitted through the system in various scenarios. So I think from an intellectual standpoint, our teams are really interested and focused on this. We've done a lot of work on this. Banks are very focused on this. Regulators are very focused on this. But I think there's we all need to be humble that we don't have all the answers yet, and we're trying to understand that. But I think through a lot of very focused analysis, a lot of collaboration on this, we can come up with some scenarios that we think are going to be likely outcomes, and we can begin to model that onto the various risk-weighted assets in the trading book to see what impacts could happen and the range of impacts that we should be considering. And then we can gradually narrow that down over time as we get better information, better analytics, and clarity. It's a hard question. So, again, we should come at it with a very humble kind of perspective here and not say that we figured it out or we know exactly what's going to happen. But I think we need to give ourselves some wide tolerances to understand what the potential is, but not ignore it either, right? We can't just put our head in the sand saying, "Oh, this isn't happening," because that just wouldn't be prudent risk management.
So, what's next for ISDA in this space for 2023?
Well, we're going to continue to work with our market participants. There's a lot of education on the front. There's, as I noted, the ICVCM, this Integrity Council, needs to roll out their solutions for voluntary carbon markets. So if there are any adjustments to that, we'll have to incorporate that into our definitions. We're going to be working with policymakers to make sure that derivatives are included in an appropriate way in the regulatory treatment in the various jurisdictions that are addressing climate change legislation or regulation. So each jurisdiction is going through its own evaluation. So there's just a lot of education feedback that we need to give. But, we're going to continue to make sure we update the standard definitions and terms so people have these tools that they can use and make these investments with confidence and certainty.
And with that, unfortunately, we're out of time. Now, as I'm sure everyone listening today has noticed, we've only just started to scratch the surface on how regulators and market participants are working together to ensure this market has the transparency, integrity, and legal certainty it needs to function safely and efficiently. With that, I'd like to thank our special guest, Mr. Scott O'Malia, CEO at ISDA, for today's discussion. Thank you, Scott.
You bet. Thanks for having me.
Thank you, and goodbye.